Welcome back. This is part 2. In part 1, we covered why acquisitions are more complex than simply adding revenue. Now let's look at what you're really buying: costs, liabilities, accounting issues, and tax consequences. Because alongside revenue growth comes new cost structures, potential liabilities, different accounting practices, tax consequences, and operational realities that may not show up clearly at first glance. This is where financial clarity becomes critical. Two businesses may look similar from the outside, but the underlying financial picture may be very different. Here are some questions you want to ask early. Are revenues stable, or are they highly dependent on just a few customers? Do the financial statements reconcile cleanly with the tax filings? Are there one-time revenue events inflating performance? Are expenses structured in a way that will change after ownership transition? These are the types of questions that help determine whether an acquisition creates real value or whether it's simply creating complexity. Another area that often gets overlooked is evaluating the purchase price itself. Many buyers focus heavily on top-line revenue or perceived growth potential, but purchase price should reflect financial realities. And that includes historical performance trends, quality of earnings, hidden liabilities, and the financial risks associated with unknown factors. A higher purchase price may make sense for a business with strong systems and stable earnings, but that same price could be risky if financial reporting is inconsistent or unclear. Tax structure is another major factor. Whether a deal was structured as an asset purchase or a stock purchase can significantly change the tax outcome for both the buyer and the seller. In an asset purchase, the buyer is usually able to step up the tax basis of the assets to fair market value, and that often creates new depreciation or amortization deductions going forward, which can reduce taxable income over time. In a stock purchase, the buyer generally takes the company as is, including its existing tax basis and any historical tax issues that may come with the entity. Depending on the circumstances, a stock deal can be simpler operationally, and it can sometimes be more favorable for the seller. But it can also limit the buyer's ability to create those future tax deductions. The key is this: the structure is not a technical afterthought. It directly affects what you keep after taxes, and it is something you want to understand before you agree on terms so you do not get surprised later. Another critical consideration is the cost of integration, not just the strategy of integration, but the financial impact it has right after closing. Even when a deal looks great on paper, you may need to budget for items like integrating accounting and billing systems, which is often more time-consuming than you might expect. You may need to adjust payroll structures and benefits. You may need to align financial reporting methods so the numbers are consistent month to month. And you may need to handle changes in inventory valuation, fixed assets, and depreciation schedules. These costs don't always show up clearly during early negotiations, but they absolutely can show up in your cash flow. And they can impact profitability in the first several months after the purchase. This is why approaching M&A from a numbers-first perspective can be so valuable. Every acquisition carries risk, and the goal is not to eliminate the risk. That's impossible. The goal is to understand the financial reality well enough to make informed decisions. So finally, I want to emphasize something very important. Growth through acquisition works best when it supports what already makes your business successful. The strongest acquisitions build on existing strengths rather than trying to completely change the direction of your company. So if you're considering buying or merging with another company, start with clarity and understand what you're trying to achieve. If you look beyond the surface numbers and make sure the financial structure supports the long-term health of your business, you'll find you have a more successful purchase. Because when approached carefully and thoughtfully, mergers and acquisitions can be powerful tools for growth.